my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your weekly technical analysis of New York and London coffee markets. I'll start with New York coffee. The failed cup with handle pattern over December 2021 to February 2022 peaked out at the October 2011 high in early February this year, with a single breach close over that 255.05 level, which was then followed by a spike up to the 260.45 area, yet it all ended with a bearish dark cloud cover pattern right at the top of the market. Since then, prices have dipped lower, halting briefly at the Fibonacci and other congestion between 227.60 and 229.15, which in reality can be seen as a wide band constructed from the combination of the July and October highs at 217.85 and 218 even respectively, plus the 50% Fibonacci of the big August 2021 to February 2022 move at 217.45. The market eventually made its way down through this congestion last week with the help of the very tight and acute bearish Andrews pitchfork. However, last Wednesday things started to change. Yet before I go into that, I'd like to say a few words, or rather repeat my comments on this bearish Andrews pitchfork from last week. Thus, and I quote, "This pitchfork is very new, very acute and very small. If it breaks, it would not surprise me." The question now is, will this market continue its moves lower, or will it get stuck, much like we saw between November 2021 and early February 2022? I'm afraid the answer is unclear. Looking a little further down, we have the rising long moving average, currently at 207.45 in reality. That's entering the frame. The last time the market was below the long moving average was back in November 2020. End of quote. Okay, so back to last Wednesday, and the market suddenly reverted back up with a combined bullish army and bullish double. Back up over the August 2021 to February 2022 50% Fibonacci line at 217.45. The action on Tuesday and Wednesday together created a pipe bottom. Then the market last Thursday made both Wednesday and Thursday into a two-day tweezer top pattern. Now, tweezer tops are traditionally seen, as the name implies, as a topping pattern. However, in reality, the data indicates that close to 6 out of 10 times, the tweezer top ends up being a bullish pattern, usually a bullish continuation pattern. This is why last Friday's and today's action has moved higher. It is not a rejection of the pattern, but a follow-on to the data rather than the tradition. Additionally, Friday's action on its own was a bullish engulfing pattern, plus the market punched up and closed over this previously described flaky bearish Andrews pitchfork. This pitchfork will be retired after this commentary. The question now is, why did the market suddenly turn back up? Well, I suspect, as I had previously mentioned in last week's commentary, that avoidance of testing the rising long moving average below, currently at 207.45, was a good enough reason. So what have we on the top side now? Well, there is, as I mentioned earlier today and last week as well, a Fibonacci and other congestion band between 227.60 and 229.15, plus the flatlining medium and short medium moving averages, currently 232.35 and 236.15 respectively. This congestion band was added in late December last year when it acted as support and as a larger resistance area, now between 230 even and 243.5 in November to mid-December 2021, and again in January to early February this year. These resistances are not immune to penetration, but it would seem unreasonable to see any quick moves. Rather, perhaps a slow grind higher should the market choose to take it further. London coffee. The key difference seen here compared to the New York contract is how the peak of the market in London was back in late December 2021, rather than when New York had it, which was in early February 2022. This difference has been crucial to the formation of two patterns here in the London contract compared to New York. We have a November 2021 to February 2022 possible head and shoulders top. Admittedly, the first shoulder was split, but the action nevertheless stacks up as a legitimate pattern. The neckline is currently at 21.42, and the market, which had broken down through it 3 weeks ago, proceeds to reject the move lower and break up back through it again last week. The break low was interesting as the market only got as far as the rising long moving average, currently at 2078, not dissimilar to your New York contract, and a thick band of congestion between 1945 to 2004 before stalling and retracing back up to the resistance provided by the August and June highs of 2017 respectively, 2173 and 2177. This places at risk the secondary target X at 1935, as the primary target X for the Head and Shoulders top has already been achieved in the 2050 area. The secondary target, as you would expect, is always that much harder to achieve. Now this segues nicely to the second bearish pattern, the late December 2021 to mid-February 2022 bearish Andrews pitchfork. This was violated at the start of its lifetime back in mid-February and last week has been broken. I'll retire it after this commentary. Overhead, we now have the rapidly declining medium moving average, currently 2193, which, to be honest, I'm not that sure of, as it has been good in the past but seems just a little too steep right now. And then also the shallowly declining short medium moving average, currently 2230. Further up, the 2017 high at 2279 looks a more interesting proposition as resistance if the market has the appetite to test it. Finally, I note the 2-day tweezer top pattern last Wednesday and Thursday that followed the data higher rather than traditional lower, much as it did in the New York contract. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Tofpik and ADM Investor Services International Limited. And here comes the final bit.